as a buyer, off-market listings might sound attractive. Less people know about the property, which means you might get less buying competition, which probably means you'll get a better chance of scoring a deal. But most of the deals that we find are actually on MLS. So in this video, let's learn more about off-market or exclusive listings, the good and the bad, and why exclusive listings doesn't necessarily give you the best chance for finding deals. If you like this kind of content, please give us a thumbs up and don't forget to subscribe to our channel so you don't miss other videos like this one made specifically for real estate investors in Toronto. Let's put ourselves in the shoes of a seller. If you're a seller, your main objective is to maximize your selling price of your property. You'll want to get as many eyes to see your property as possible, so typically the best place is to list your property on the Real Estate Multiple Listing Service, MLS, and that's why most of the properties for sale are listed there. Now, if that's the case, why would some sellers choose an off-market listing, meaning they don't put it on MLS? The first reason that happens once in a while is when an income property has a higher purchase price that exceeds what most individuals can qualify for. These are typically multiplexes that's in that awkward middle spot where individuals tap out at the banks and can't borrow enough to buy it, but the property is still too small to attract attention from big-time developers. So in this case, buyer demand drops significantly, which can impact the days on market, and it looks especially bad when this information is seen publicly on MLS. So these sellers might decide to list privately in this case if there's access to the right real estate investor audience that's looking specifically for investment properties in Toronto. The second reason for exclusive listings might be because the seller isn't in a rush and they want to test the market first, typically with a higher selling price. At that higher list price, again, there will be less buyer action, so the property might sit on the market for a long time again. And when a property sits on the market for a long time, it starts to look bad, and the end result might be opposite to what they actually want to achieve, which is sell at a higher price. So these sellers might also choose an exclusive listing to give them more flexibility and also less pressure to sell quickly. The last and probably most popular reason for an exclusive listing is that the property is just simply harder to sell because there's something wrong with it. Nightmare tenants, shockingly low rents, or the house is falling apart and probably needs a ton of work. It's the same reason here though. The sellers don't want to see a long days on market, so they choose an off-market listing here too. So if you're looking at off-market listings, the most attractive deals are those that are in the last situation. Again, these properties are not your typical properties, and they most likely need a ton of work in order to turn things around. It's true that it's possible to get better returns here, mainly because you'll benefit from that higher value add appreciation that you put in, and perhaps a slight discount as well because of less buying competition. But the most important thing here is to remember that what you're doing is essentially trading higher risk and work for higher returns. If you're new to real estate investing, it's probably not the best first project to take on because things can get overwhelming. Inheriting bad tenants can be pretty complex. You might have to go through the landlord-tenant board, which normally takes a long time already, but now with COVID, things have been delayed even more, so there's a big element of unknown. Plus, there's likely higher costs, work, and time involved in turning over tenants. Major renovations are also high risk and not always as pleasant as what you see on HGTV, where everything can be easily resolved by the end of the episode in 30 minutes. Once you open up walls, you might unveil bigger problems which the home inspector couldn't see, and then you're left with much longer renovation time and higher renovation costs than expected. The last thing you have to keep in mind is the higher borrowing risk. When a property isn't your normal property, banks might give it a lower appraised value because it's just not in good condition. And when that happens, instead of qualifying for 80% loan to value, you might only get 65%, and this can significantly bump up your capital requirements. So to recap, what you might get with an off-market listing, which is rare in general, is higher risk but higher reward. And just for fun, here is how I would compare risk and returns on a typical MLS listing versus an off-market listing, and we can even compare that with scoring a deal on MLS as well. We'll skip leverage to keep things simple and look at total returns that come from a combination of rental income, market appreciation, value add appreciation, and gains from buying with a discount. For a typical MLS investment property that you buy at market value, you'll be getting market rents and market appreciation. You might put in some cosmetic renovations to maximize your rental potential, but these are generally pretty low risk. After the upgrade, you'll benefit from a one-time small bump in value add appreciation as well. Remember, things can change drastically between properties, so here's just some general return numbers as an example. You'll get 4% annually from rental income, 5% from appreciation, and you might also get a 5% bump in property value after you put in those cosmetic renovations. If you're looking at an off-market deal, you'll have to put in a lot more work to turn things around in order to achieve that same market rent and same market appreciation. At the same time, you trade your work or higher risk for better returns, and you'll probably get a bigger bump in value add appreciation here. So, as another example, this off-market property will generate the same 4% rental income and 5% appreciation after you put in the work. Plus, you also gain a bigger 10% instead of 5% from value add appreciation. And because it's an off-market deal, you might also score a 5% discount. Now, let's consider the third case, scoring a deal on MLS. The market has slowed significantly since the peak in Q1, and we've been able to see some decent discounts on certain MLS properties when you encounter the right motivated seller. So here you benefit from buying at a good discount, but you don't inherit the same complex investment risk that you get from the off-market deal. And of course, there are MLS properties that also need a lot of work. So if you buy these properties from MLS, then you might get the same higher value add appreciation as the off-market case, plus you might score a bigger discount with a more motivated MLS seller. The takeaway here is that deals can be anywhere, and because there is so much more inventory on MLS, the chance that you'll find a deal on MLS is probably better than an off-market listing. We're constantly searching the market, so we know where the best opportunities are on the market at any time. If you're looking to buy an investment property, we'll look at your requirements and match you up with the best investment property in Toronto for you. If you want to have a chat, just connect with us by heading to the link I'll put in the description below. Don't forget to give this video a thumbs up, and if you want to stay in touch with us more regularly, look for us on Facebook, Instagram, or LinkedIn. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye!